Elon Musk has achieved a historic milestone by becoming the first individual to reach a net worth of $500 billion, driven primarily by a recovery in Tesla's share price and the increasing valuations of his other tech enterprises. Musk's wealth, which briefly hit the $500 billion mark before settling at $499.1 billion, is heavily influenced by his approximately 12% stake in Tesla. The electric vehicle manufacturer has seen its stock rise by about 14% this year, bolstered by Musk's recent $1 billion purchase of Tesla shares, signaling his confidence in the company's transition towards artificial intelligence and robotics. Furthermore, Tesla's board has proposed a $1 trillion compensation plan for Musk, which has already contributed to a 35.7% increase in the company's stock since its announcement. Beyond Tesla, Musk's ventures such as SpaceX and his AI startup xAI have also seen significant valuation increases, with SpaceX reportedly raising funds at a $400 billion valuation and xAI at $200 billion. SpaceX continues to dominate the commercial space sector, operating the largest satellite network through Starlink and securing a majority of U.S. launch contracts. Meanwhile, xAI is expanding its supercomputer Colossus to compete in the AI space against established players like OpenAI's ChatGPT and Google's Gemini. This surge in Musk's wealth further widens the gap between him and other billionaires, with Oracle founder Larry Ellison trailing as the second richest person with a net worth of approximately $350.7 billion.
The ongoing U.S. federal government shutdown has intensified partisan tensions, with House Speaker Mike Johnson asserting that Republicans have proposed a clean continuing resolution, CR, to extend current funding levels through December. This measure, Johnson claims, mirrors prior agreements supported by Democrats earlier this year, yet Senate Democrats have repeatedly blocked the bill. The impasse highlights a deepening divide, with Republicans accusing Democrats of using the shutdown to push for additional spending on healthcare subsidies and benefits for undocumented immigrants, totaling over $1.4 trillion. Johnson's stance emphasizes that the proposed CR does not include additional Republican priorities, framing the Democrats' rejection as politically motivated. The shutdown's economic impacts are already being felt, with non-essential federal operations suspended and essential workers like air traffic controllers working without pay. Analysts warn that the prolonged closure could cost the economy billions, drawing parallels with the 2018-2019 shutdown. Despite historical precedents where clean CRs have served as temporary solutions, the current political dynamics, marked by a slim Republican majority in the House and a Democratic-controlled Senate, complicate prospects for a swift resolution. As negotiations remain stalled, the potential for a bipartisan compromise hinges on whether moderates from both parties can bridge the divide amid mounting public frustration and economic pressures.
Nebius Group NV, Nasdaq, NBIS, shares have seen an uptick following a significant development involving Microsoft Corp., Nasdaq, MSFT, and Nvidia Corp., Nasdaq NVDA. The rise in Nebius's stock price is attributed to a multi-billion-dollar agreement with Microsoft announced in early September. This deal, valued at up to $19.4 billion, grants Microsoft access to over 100,000 Nvidia GB300 chips. These chips are crucial for supporting Microsoft's AI infrastructure, particularly for developing large language models and consumer AI assistants. The arrangement aims to alleviate data center shortages, enabling Microsoft to allocate more resources towards delivering AI services, a sector experiencing burgeoning demand. This partnership is part of Microsoft's broader strategy to collaborate with various neo-cloud providers like Nebius, CoreWeave, Nscale, and Lambda, with over $33 billion in commitments. The partnerships are critical to meeting the rising AI demand driven by products such as GitHub Copilot and OpenAI's ChatGPT. The impact of this deal is significant for Nebius, as it positions the company as a key player in the AI infrastructure space, potentially leading to increased investor interest and a positive shift in market sentiment. At the time of reporting, Nebius's stock has risen by 3.31%, trading at $119.52, reflecting investor optimism about the company's future prospects in the AI domain.
Royalties Inc. is scheduled to present at the Metals and Mining Virtual Investor Conference on October 8, 2025. CEO Tim Gallagher will lead the presentation, offering insights into the company's operations and future strategies. This event is part of the Virtual Investor Conferences series, designed to enhance transparency and investor relations by allowing companies to engage with investors in real time through interactive online sessions. Royalties Inc., listed on the CSE as RE and OTCID as ROYIF, holds significant assets in the mining sector, including a 100% interest in the Bilbao silver-zinc lead project in Zacatecas, Mexico. The company is currently involved in a legal dispute with Capstone Copper Corp. over a 2% net smelter royalty on 5 mining concessions, although a court ruling favored Royalties Inc. subsidiary, Minera Portuaria de Zacatecas. Capstone has appealed the decision. This ongoing legal battle could affect Royalties Inc.'s revenue streams and investor sentiment, depending on the outcome. In addition to its mining interests, Royalties Inc. has diversified its portfolio by holding a 4.9% stake in Music Royalties Inc., which has generated over $12 million in dividends from music catalog investments. This diversification strategy aims to provide financial stability amidst the volatile mining sector, potentially attracting a broader investor base. The conference will serve as an opportunity for Royalties Inc. to address investor concerns, particularly regarding the legal proceedings and their potential financial implications.
The logistics industry is undergoing a transformative shift as companies increasingly adopt eco-friendly moving equipment to enhance sustainability, reduce costs, and meet regulatory demands. Key players in the sector are transitioning from traditional diesel-powered machinery to electric forklifts, hybrid delivery trucks, and solar-powered warehouse systems. This shift is driven by the need to reduce carbon emissions, lower operational costs, and comply with stricter government regulations on emissions and waste management. By investing in sustainable practices, logistics companies not only contribute to global climate goals, but also position themselves strategically in a market where consumers increasingly value environmental responsibility. The adoption of eco-friendly equipment such as electric forklifts and reusable pallets offers significant financial benefits. Although the initial investment in green technology can be higher, the long-term savings from reduced fuel consumption, lower maintenance costs, and extended equipment lifespan outweigh these costs. Additionally, companies that prioritize sustainability are able to build stronger relationships with eco-conscious customers, enhancing brand loyalty and trust. As governments implement more stringent environmental regulations, early adopters of green logistics solutions are better positioned to avoid penalties and maintain smooth operations, giving them a competitive edge in the evolving market landscape.
Gold and silver have experienced a significant rally, surging over 50% in the past year, amid rising global financial uncertainty. This price surge has brought renewed attention to the role of precious metals as safe haven assets, sparking debate between financial heavyweights Robert Kiyosaki and Warren Buffett. Historically, Buffett, the CEO of Berkshire Hathaway, has been critical of gold and silver, viewing them as non-productive assets compared to income-generating businesses or stocks. However, his recent endorsement of these metals has surprised many, suggesting a potential shift in his investment philosophy due to current volatile economic conditions. Robert Kiyosaki, author of Rich Dad Poor Dad, has long advocated for investments in gold, silver, and cryptocurrencies as protection against inflation, geopolitical tensions, and currency weakness. He interprets Buffett's newfound support for precious metals as a sign of impending turbulence in equity and bond markets, warning of a potential downturn comparable to the Great Depression. The current rally in precious metals is attributed to a weaker dollar, fears of slowing global growth, and geopolitical risks, which have increased demand for safe assets. This environment underscores Kiyosaki's belief that traditional assets are vulnerable, and he advises investors to diversify into alternative stores of value to better weather potential financial storms.
During the second quarter of 2025, several institutional investors, including Warren Street Wealth Advisors LLC and Clifton Larson Allen Wealth Advisors LLC, increased their holdings in the iShares Core S&P Midcap ETF, NYSEARCA, IJH, reflecting a broader trend of growing interest in mid-cap equities. Warren Street Wealth Advisors LLC boosted its stake by 20.1%, now holding 18,608 shares valued at approximately $1.154 million. Meanwhile, Clifton Larson Allen Wealth Advisors LLC increased its holdings by 4.9%, acquiring an additional 5,510 shares, bringing their total to 117,608 shares valued at about $7.29 million. The ETF, which tracks the performance of the S&P Mid-Cap 400 Index, currently has a market capitalization of $100.38 billion. It opened at $65.49, with a price-to-earnings ratio of 19.00 and a beta of 1.12, indicating moderate volatility. The ETF's price is above its 200-day moving average of $61.25 and has a 50-day moving average of $64.57, showing a bullish trend. The 52-week price range is between $50.15 and $68.33. Institutional investors and hedge funds own 14.60% of the ETF's stock, suggesting robust confidence in mid-cap stocks, which are viewed as offering a balance between growth potential and stability. This increased institutional investment is likely to contribute to continued positive momentum for mid-cap stocks in the near term.
USA Financial Formulas has recently invested $668,000 in Intercontinental Exchange, Inc., NYSE, ICE, by acquiring 3,640 shares during the second quarter. This move is part of a broader trend where significant institutional investors have increased their stakes in ICE. Notably, Price T. Rowe Associates, Inc., MD, amplified its holdings by 491.3% in the first quarter, while Nuveen LLC and Wellington Management Group LLP also made substantial investments, underscoring growing confidence in the financial services provider's performance and prospects. Intercontinental Exchange, a prominent player in market infrastructure and data services, reported robust financial results, with a 9.8% increase in revenue in the latest quarter compared to the previous year, reaching $3.26 billion and surpassing analysts' expectations. The company also demonstrated strong profitability, with a return on equity of 13.66% and a net margin of 23.92%. Analysts remain optimistic, with several raising their price targets, highlighting the company's solid position and growth potential in the financial services sector. The consensus rating for the stock is a moderate buy, reflecting positive sentiment among market participants, despite recent insider selling activities, which saw a modest reduction in stock ownership by certain directors. The overall institutional ownership remains high at 89.30%. This indicates sustained institutional confidence in ICE's strategic direction and market position. As the company continues to expand its global footprint across regions such as the US, EU, and Asia, it remains a key entity to watch in the financial services landscape.
Recent transactions by Northstar Group Inc. and Warren Street Wealth Advisors LLC, acquiring 289 and 293 shares of the Goldman Sachs Group Inc. respectively, underscore ongoing institutional interest in the firm. These acquisitions, valued at approximately $205,000 and $207,000, are part of a broader trend of active trading among institutional investors, who currently own 71.21% of Goldman Sachs stock. This reflects strong institutional confidence in the company's performance and prospects. Goldman Sachs stock is trading at $788.44, with a year-to-date high of $825.25. The company has demonstrated robust financial health, reporting a quarterly earnings per share, EPS, of $10.91, which exceeded analyst expectations, and a 14.5% year-over-year revenue increase to $14.58 billion. This growth is attributed to its diversified financial services offerings and strong returns on equity. Additionally, Goldman Sachs has increased its quarterly dividend from $3 to $4 per share, resulting in a 2.0% dividend yield, affirming its commitment to returning value to shareholders. Despite some insider selling, such as COO John E. Waldron's sale of 9,000 shares and recent stock volatility with a 1.0% decline, market analysts have mixed ratings on Goldman Sachs. The consensus rating is hold, with an average target price of $709.13. However, Wells Fargo has issued an overweight rating, raising its target price to $855, indicating some bullish sentiment. As a key player in the financial sector, Goldman Sachs' strong market position and recent earnings outperformance are closely monitored by investors for potential future growth and strategic investment decisions.
Clifton Larson Allen Wealth Advisors LLC has reduced its stake in the iShares S&P 500 Growth ETF, NYSEARCA, IVW, by 7.1% in the second quarter, now holding 1,005,071 shares valued at approximately $110.66 million. This adjustment makes the ETF the 12th largest holding in their portfolio, constituting about 1.9% of their total assets. The iShares S&P 500 Growth ETF, which tracks the performance of the large-cap growth sector of the U.S. equity market, has seen its stock price rise, opening at $121.23, with a market capitalization of $66.43 billion. The ETF's price has fluctuated between a 52-week low of $79.31 and a high of $121.77. Other investment firms have also been active with IVW. NBC Securities Inc. notably increased its stake by a significant margin, while other firms like CGN Advisors LLC and Watershed Private Wealth LLC have also raised their holdings. The ETF's recent performance, marked by a P/E ratio of 33.33 and a beta of 1.05, suggests a relatively high level of volatility compared to the broader market. This activity reflects a broader trend among institutional investors adjusting their positions in growth-oriented ETFs, likely in response to shifting market conditions and economic forecasts.